You don't have to chase the noise, we already did. We read the data, we watch the movements, we trace the patterns behind every headline. What you get here isn't just information, it's clarity. You don't have to scroll endlessly or compare 1,000 opinions. We do the digging, we face the chaos, we bring you what matters. All you need to do is listen. Bitcoin didn't drop that day. It revealed who was borrowing their conviction. Tonight, our cover is when leverage writes Bitcoin's story for you, and you can feel why it matters. BlackRock's digital assets lead is looking past the headlines and pointing at the real author of these violent chapters. Stacked leverage, cascading liquidations, and the quiet machinery of auto-deleveraging that turns a small headline into a 20.0% bruise. And here's what we're really doing together in this live. We're separating Bitcoin the asset from Bitcoin the trade. Because you've watched it climb back towards 70,000 while fear still lingers in the room, and you've probably wondered why the hedge sometimes behaves like a stress tech stock. So stay with us. We're going to trace where the volatility actually comes from, who's stepping back, and what it means when the market starts pricing belief on margin, without saying it out loud. BlackRock's digital assets lead warns. Leverage volatility could break Bitcoin's story. You can feel the contradiction, can't you? Bitcoin is sold as long-term certainty, yet it's often moved by short-term fragility. And when the swing comes from leverage, the market is not discovering truth. It is tripping over its own borrowed confidence. We are watching a strange split form. On one side, institutional access is maturing, with BlackRock's Bitcoin exchange-traded fund becoming one of the most successful launches modern finance has seen. On the other side, the wider crypto arena is leaning harder on derivatives, and that leverage is writing a different narrative in the price. Robert Michnik, who leads digital assets at BlackRock, is pointing to that gap and asking you to notice what it does to adoption. He is not saying Bitcoin's foundation has cracked. He is saying something subtler and more dangerous. The foundation can remain intact while the public impression decays, because institutions do not allocate to stories alone. They allocate to behavior, to how an asset moves when the room gets cold. Michnik describes days when a small headline should barely ripple the surface, yet Bitcoin drops as if the floor gave way. He points to one example around October 10th, a tariff-related note, and suddenly the market is down about 20%. Not because the world changed, but because positioning did. Leverage creates a chain reaction. Liquidations trigger more liquidations, and automatic deleveraging turns a shove into a stampede. Here is the first micro hook. What if the real volatility is not fear, but forced selling disguised as fear? When you borrow to hold an asset, you are not simply expressing belief, you are renting time. And rented time expires at the worst moment, because margin calls do not care about your thesis. They care about collateral right now. Michnik keeps returning to the long arc. Bitcoin, in his view, still carries the core attributes people came for. Global reach, engineered scarcity, decentralization, monetary independence. But he warns that short-term trading is starting to resemble something else entirely, something familiar to traditional allocators for the wrong reasons, a leveraged technology index. If Bitcoin trades like a levered NASDAQ proxy, the mental hurdle for conservative portfolios rises sharply. Not because the fundamentals changed, but because the risk committee's imagination did. And that is the paradox you and we have to sit with. The facts can stay steady while the adoption curve bends, simply because the tape looks unstable. In markets, perception is not decoration. It is a cost. Then he turns to a common accusation and quietly rejects it. Some believe the new exchange-traded funds are the engine of these violent moves, that hedge funds inside the fund structure are whipping the market and dumping into stress. But what Michnik says they observe is almost the opposite. In a week of turmoil, redemptions from the fund were around 0.2%. If large fund players were unwinding at scale, you would expect flows measured in the billions of dollars. Instead, he points your attention to where the damage actually appears: the leveraged perpetual futures venues, where many billions of dollars can be liquidated when the cascade begins. Second microhook. If the calm pool is not the source of the wave, why do we keep blaming the water instead of the wind? Notice what he is really defending. Not a product, not a ticker. He is defending a pathway for institutions to approach Bitcoin without stepping into a casino of reflexive leverage. A bridge only works if the ground on both sides holds. And that is why BlackRock's posture remains steady, even as he critiques the market's habits. Michnik frames their role as connective tissue between traditional finance and the digital asset world, because over time clients will want exposure to this technology theme and to these new forms of property. But the bridge is not the destination. It is the discipline that makes the destination reachable. Though we end in a quieter place, you and we, Bitcoin may still be what it always claimed to be. The question is whether the market will let it appear that way, or whether leverage will keep repainting it into something more convenient for traders and less tolerable for stewards of capital. And if you feel that tension, sit with it a while. It has a way of revealing what you thought you were buying when you said you believed. XRP moves faster than Bitcoin and Ether after the crash taught investors where to look. You felt the panic earlier this month, and yet something quieter happened underneath it. While most eyes stayed on the giants, a different crowd began treating the drop like an invitation. Now XRP is climbing faster than Bitcoin and Ether, and the trail it leaves behind is not noise, it is intent. A crash never changes what people value. It only forces them to reveal it. XRP, a payments-focused cryptocurrency, has been rising more quickly than Bitcoin and Ether as investors search for bargains after the early month sell-off. Since February 6th, XRP has rallied about 38% to around $1.55 after printing a local low near that date. Even in the last 24 hours, it added more than 5%, as if the market were testing whether conviction still exists when the fear has already passed. Bitcoin and Ether also recovered, but with less urgency, up roughly 15% over the same window. They recently traded near $69,420 for Bitcoin and about $2,020 for Ether. Strong moves, yes, but not the same kind of sprint. Here's the first micro hook you should sit with. When price rises, are we watching optimism return or supply quietly disappear? Because the more interesting signal is not the chart. It is the behavior around custody. After the crash, data pointed to dip buying on Binance, where XRP reserves fell by roughly 192.37 million XRP, sliding to about 2.553 billion between February 7th and February 9th. That decline of around 7% pushed exchange holdings to their lowest level since January 2024, and then the balance steadied as if the transfer was not a fluke but a decision. We both know what that usually means. When investors plan to trade, they keep coins close to the exit. When they plan to wait, they remove them from the exchange and take direct custody. It is not a slogan about belief, it is a practical move under uncertainty. Second micro hook. What if the rally is not demand exploding but availability shrinking? Sudden withdrawals tighten the float. Fewer coins sit ready to be sold at a moment of doubt, and that alone can let price rise with less resistance. History has rewarded this pattern before. In the final 2 months of 2024, XRP surged from about 60 cents to above $2.40, while exchange balances were falling faster. A reminder that markets often move not when everyone agrees, but when the marginal seller quietly runs out of inventory. So when you see XRP outrunning Bitcoin and Ether, we are not just seeing a token outperform. We are watching a crowd answer a question the crash asked them. Do you want liquidity, or do you want ownership? And if you catch yourself wondering whether this is strength or just a temporary echo, hold that thought. The market rarely announces accumulation with words. It shows you in withdrawals, in patience, in the choice to leave the marketplace and sit with risk privately. If that feels familiar to you, it is because you have seen it before, you just had not named it yet. You don't have to chase the noise. We already did. We read the data, we watch the movements, we trace the patterns behind every headline. What you get here isn't just information, it's clarity. You don't have to scroll endlessly or compare 1,000 opinions. We do the digging, we face the chaos, we bring you what matters. All you need to do is listen. Wall Street stays long on Bitcoin as offshore leverage quietly backs away. You can feel it in the spread, can't you? One side of the world still pays to hold the future, while the other side starts stepping back. The difference is not a headline. It is a confession of risk appetite, written in futures pricing. Watch what happens when sentiment splits across borders. In the Bitcoin market, that split is widening. United States institutions remain steady in their posture, while offshore traders reduce exposure. Same asset, same chart. Different willingness to endure uncertainty. The cleanest signal is not in speeches or social feeds. It is in futures. On the Chicago Mercantile Exchange, the place where hedge funds and institutional desks prefer to express conviction, traders continue paying a premium to stay long. That premium is a choice. A willingness to lock in a higher futures price than the spot price because they still want the position. Now, compare it to the offshore arena, where leverage often speaks louder. On Deribit, the equivalent premium has fallen more sharply. In plain terms, the markup for holding a leveraged long is fading there faster than it is on the United States venue. Here's the first microhook. If everyone is looking at the same Bitcoin, why do they price time so differently? The deduction is simple, and it is human. When the offshore basis drops harder, it suggests traders are less hungry for leveraged upside. Not necessarily because they have discovered a new truth about Bitcoin, but because their tolerance for carrying risk has changed. The widening gap between the Chicago Mercantile Exchange and Deribit becomes a live gauge of geography itself, who still reaches forward and who has started protecting the present. And then price moves and people rush to explain it. Earlier this month, Bitcoin fell to $60,000 before rebounding. Some pointed to a dramatic story, fears that quantum computing could someday weaken cryptographic security. It sounds sophisticated. It also sounds like what the mind does when it wants a single villain for a complex retreat. But notice what careful comparison reveals. Bitcoin's movement tracked alongside publicly traded quantum computing companies such as IonQ Incorporated and D-Wave Quantum Incorporated. If quantum risk were truly the weight dragging on crypto, you would expect the supposed beneficiaries of that fear to rise as Bitcoin falls. Instead, they fell together. Second micro hook. What if the market was not pricing a technical threat at all, but a mood? When Bitcoin and future themed, quantum equities decline in tandem, the pattern points to something broader. A cooling appetite for long-duration bets, the kind of assets people buy when they feel patient about tomorrow. This is not about one technology overthrowing another. This is about time preference shifting under stress. Even the search behavior tells on us. Interest in the phrase, quantum computing Bitcoin, tends to rise when Bitcoin's price rises. That is not fear leading price. That is price leading narrative. We search for reasons after the fact, because uncertainty is uncomfortable, and stories make it feel managed. So we end up here with two truths sitting side by side. Institutional desks in the United States still pay for exposure, while offshore traders ease off the leverage. And the loudest explanation is not always the causal one, just the most emotionally convenient. If you sit with this for a moment, you may notice something you can reuse the next time a market panics. Prices move first and most explanations arrive later, dressed as prophecy. If that feels uncomfortably familiar, it is worth holding on to that discomfort. It might be the clearest signal you have. We are Blocksonic. We do not predict the market. We read its memory. Bitcoin returns to $70,000 as inflation cools, but fear stays in the room. You can watch price rise and still feel the crowd flinch. We are going to trace why Bitcoin's rebound says less about confidence and more about what people think interest rates will do next. You notice the contradiction first, don't you? Bitcoin can climb back towards $70,000, and yet the market can still behave like it is bracing for impact. After sliding close to $60,000 earlier in the month, Bitcoin pushed back above that $70,000 line, as if reclaiming lost ground could erase the memory of the fall. In the last 24 hours, it rose by nearly 5%, while a broader basket of major coins moved even faster. But price is never just price. It is a compressed confession about expectations. The spark this time was not a new technology or a new narrative. It was a softer inflation reading in the United States. The Consumer Price Index for January rose 2.4% year over year, slightly below the 2.5% many expected. And in markets, being less wrong than feared can look like good news. Here's the mechanism, and you already understand it in your bones. If inflation appears to cool, people start to imagine interest rate cuts arriving sooner. And when the return on safer places to hide begins to look smaller, risk starts to feel less sinful. Stocks lift, crypto lifts, not because the world became certain, but because the cost of waiting became higher. Microhook. What if this rally is not belief in Bitcoin at all, but disbelief in cash yields? You can see that expectation forming in the places where traders try to turn uncertainty into odds. On prediction markets, the perceived chance of a rate cut in April moved higher within days, drifting from the teens into the 20s. Nothing happened in the real economy at that speed. Only minds moved, and when minds move together, prices follow. Still, we should not confuse movement with healing. Under the surface, anxiety has not left. A sentiment gauge built to measure crypto fear and greed continues to sit near extreme fear, levels that recall the deep wounds of the 2022 bear market and the collapse of a major exchange. That matters because fear changes the meaning of every bounce. In fear, a rally is not an invitation. It is an exit sign. Another microhook. If confidence were truly back, why would you feel like a chance to run? The losses tell you why. Analysts observed that about $8.7 billion of Bitcoin losses were realized in the last week, a figure surpassed mainly during one of the most violent unwindings of the previous cycle. Realized losses are not theory. They are decisions made under pressure. They are people choosing pain now over uncertainty later. And yet, even that has a hidden order. When weaker hands sell into stress, the asset does not vanish. It changes owners. Supply rotates from those who needed liquidity or reassurance into those who can tolerate waiting. Historically, that redistribution can mark the early stages of stabilization, not because it is magical, but because ownership structure affects how easily panic can find sellers. Time is the price of that transition. It never happens in a single candle. We also see the strain in corporate treasuries that hold Bitcoin. At one point, those firms collectively sat on more than $21 billion of unrealized losses, an all-time high. As Bitcoin recovered, that unrealized loss figure fell toward $16.9 billion. Notice the psychology. Nothing fundamental changed about their coins. Only the market's willingness to value them higher changed the story those balance sheets could tell. The current rise is also being carried by thinner weekend liquidity and something traders call seller exhaustion. After a wave of capitulation, There are moments when the market lifts simply because the urgent sellers have already acted. The absence of pressure can look like demand. That is not deception. It is structure. But fear remains the main driver, not fear of missing out. Fear that the floor is not a floor. When that is the mood, many participants treat each upward move as a brief patch of dry ground to step on before the next wave arrives. So we end where the market really lives, inside the choice each holder makes. Do you sell rallies because you expect lower prices, or do you hold through noise because you believe ownership is migrating toward conviction? Both are purposeful actions. Both create the next price. And if you feel that tension while you watch 70,000 return, stay with it. The most useful comments are not predictions here, but admissions of what you would do when the screen turns red again. Because that is where the market's truth hides, waiting to be spoken aloud. We are Blocksonic. We do not predict the market. We read its memory. And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. Truth Social pushes for 2 crypto exchange-traded funds, and the real test is trust. The paperwork looks ordinary, but you and we both know the motive is never just paperwork. A politically branded platform is asking regulators for permission to package Bitcoin, Ethereum, and even staking yield into products that feel familiar to traditional investors. And beneath that surface, a quieter question forms. When politics, custody, and crypto meet, what exactly is being sold? You can feel the tension in this before we even name it. Crypto was born as an exit from permission. And yet here it is again, asking for permission to be wrapped, labeled, and distributed, like everything else. Yorkville America Equities, the manager building exchange-traded funds tied to the Truth Social name, has filed for 2 new crypto funds. On paper, it is an expansion into a growing market. In human action, it is something more precise, a brand reaching for a new kind of legitimacy and a new kind of demand. The filing went to the United States Securities and Exchange Commission on Friday. The first product is framed simply. A Truth Social Bitcoin and Ethereum exchange-traded fund designed to give exposure to the 2 largest crypto assets by market size. This is the familiar bridge Wall Street understands. You do not need to hold the asset, only the claim that tracks it. But the second filing tells you where the experiment becomes more revealing. A Truth Social Chronos Yield Maximizer exchange-traded fund, built around the Chronos token and explicitly tied to staking, not just price exposure. Participation in the mechanism that secures a proof-of-stake network translated into a yield story. Here's the micro-hook you should sit with. When yield enters the room, does the investor start thinking like an owner or like a renter? Both funds still depend on approval. And that dependency is the point. If the regulator agrees, the launch is expected to happen with Crypto.com as partner, serving as custodian, liquidity provider, and staking services provider. In other words, the system becomes a chain of trust. You trust the fund trusts the service providers, and the service providers interact with the network. Crypto did not remove trust. It relocated it. Sometimes it concentrated it. The Chronos-focused product stands out because staking rewards are not a marketing garnish. They are compensation for taking on specific constraints, lockups, slashing risks, operational dependency, and the subtle reality that yield is never free. In a market still dominated by passive spot-style exchange-traded funds, this is an attempt to sell movement, not stillness. A return stream, not just a price chart. Another micro hook. Because it matters. If the product promises yield, what must be true about the risks for that yield to exist? Distribution would run through Forest Capital United States Limited Liability Company, a broker-dealer registered with the Commission and affiliated with Crypto.com. That detail sounds procedural, but it is how access becomes scale. Scale is how narratives become flows, and flows are what turn ideas into price. Truth Social signaled this direction earlier, filing in June of 2025 for a spot Bitcoin exchange-traded fund under the same brand. Then came a blue-chip digital asset exchange-traded fund, filing in July of 2025, aimed at a basket of large-cap alternative coins. Neither has launched yet, which tells you something simple. Intention is easy, clearance is hard, and timing is a strategy all by itself. And then we reach the part everyone tries to treat as separate, even though it never is. President Donald Trump is a primary owner of Trump Media and Technology Group, which owns Truth Social. That proximity between political identity and crypto business interest has become a friction point in the wider push for rules, including the United States Senate effort around a Digital Asset Market Clarity Act, meant to shape oversight. You see the contradiction now. The market wants clarity, because clarity lowers uncertainty. Politics wants advantage, because advantage wins contests. And the individual investor wants upside, because time is scarce and the future is expensive. So we end with the quiet question that does not go away. When a brand asks you to buy exposure to decentralized assets through centralized wrappers, are you buying crypto, or are you buying a story about who gets to be the trusted middle again? If you find yourself returning to that question later, it is because the answer was always there, waiting for you to notice it. Uniswap lifts the CoinDesk 20 as breath quietly returns. You can feel it when a market stops arguing with itself and starts moving together. Today, we watch a broad index lean upward, not because one voice shouted, but because most participants chose the same direction at once. We are looking at a daily snapshot from CoinDesk indices, and you are meant to notice the structure beneath the motion. The CoinDesk 20 index is trading at 1920.47, higher by 2.0% since 4 post-meridian Eastern Time on Thursday, a rise of 36.7 in index points. That sounds like a number, but it is really a confession. It tells you that, for this moment, more people are willing to hold risk than to run from it. Here is the coordination. 18 out of 20 assets in the basket are trading higher. Not a perfect unanimity, but enough to change the atmosphere. When breadth expands like this, it is rarely about a single story. It is about many separate minds, each acting on local knowledge, accidentally harmonizing. And then you see the leaders, the ones pulling the eye first. Uniswap is up 5.4%, and Bitcoin Cash is up 5.3% since Thursday. We do not treat that as a trophy. We treat it as a clue. Capital is rotating toward what it believes will be liquid, useful, and survivable in the next stretch of uncertainty. Ask yourself this: why do the winners always look obvious only after they have already moved? Even in a rising tide, something resists. Internet Computer is down 2.1%, and Binance Coin is down 1.1%. That is the other half of the truth. A market can lift as a whole while still punishing specific expectations. Prices do not reward effort. They reward alignment with what others will value next. Another question worth holding. If most assets are higher, what is the minority seeing that the majority is ignoring? The CoinDesk 20 matters here because it is broad-based, traded across multiple platforms and several regions globally. In other words, it is not one room making noise. It is many rooms, many time zones, many preferences, compressing their disagreements into a single, tradable signal. And when that signal tilts upward, we do not call it certainty. We call it a temporary peace treaty between fear and hope, written in price and signed by millions of small decisions. If you sit with that for a moment, you may notice something subtle in yourself too. You were never really watching coins. You were watching coordination appear, disappear, and return. What does it say about us when the crowd briefly agrees without ever meeting? And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. Bitcoin and Ethereum hold their breath before the United States inflation signal. You can feel the stillness, can't you? Price barely moves, yet everyone is listening. In derivatives, the mood turns cautiously constructive. Leverage looks cleaner, funding leans positive, and institutions pay a steadier premium even while traders keep buying near-term insurance against a sudden drop. We are watching a market do something that looks like boredom, but is really discipline. Bitcoin tried to climb toward $67,000 early Friday, touched the edge, and was pushed back quickly. And yet, it still sits modestly higher on the day, while Ethereum follows with a smaller step. The broader basket of major coins barely shifts. A small rise, not a declaration. The kind of movement that tells you the crowd is not convinced enough to chase and not frightened enough to flee. But notice the contradiction. These small gains feel like recovery from the prior United States session, where prices slid back toward last week's lows. And still, Bitcoin remains on pace for a fourth straight week of decline, the longest losing stretch since mid-November. The market is not collapsing. It is confessing hesitation. Here is the quieter pressure you might miss. Activity slows, volatility fades, and volume thins. When fewer people trade and fewer people disagree, the tape can look calm while conviction quietly drains away. So what are they waiting for? Not a chart pattern, not a rumor. They are waiting for a single public number. The United States Consumer Price Index reading due later today, because it changes the story investors tell themselves about the next few months. Micro hook. What does inflation have to do with Bitcoin's next breath? Everything, because the inflation print can reshape bond yields and the dollar, and those two often decide how much pain risk assets must endure. If the reading comes in hotter than expected, yields and the dollar can rise, and the market's appetite for risk can shrink. If it comes in softer, conditions can feel easier, and risk-taking can return without needing anyone's permission. And yet, even in this tentative optimism, traders are not acting naive. Look at the options market, and you see it. They are still paying extra for short-term downside protection. Hope, but with a helmet on. That is not euphoria. That is memory. Microhook. Why would funding turn positive while fear still commands a premium? Because markets are not one mind. They are a negotiation between time horizons. The short-term buyer wants shelter. The longer-term participant senses that forced leverage has been washed out and that the remaining positions are less fragile. Still, we should not pretend a single data point can heal everything. To lift Bitcoin toward $85,000 would require more than a gentle tailwind. It would take a meaningful shift in the conditions that finance risk itself. Even Deribit's chief commercial officer, Jean-David Pequignot, frames that level as a kind of structural test, the point where you could argue the longer-term rally is no longer broken. So we sit with a market that looks unchanged, but is actually choosing its next sentence. You can almost hear it. Institutions inching forward, traders buying protection, everyone waiting for the same inflation print to tell them which story will be easiest to believe. And if you find yourself pausing here too, that is the honest response. In moments like this, the real signal is not the price. It is the way people insure themselves against the future they say they do not expect. We are blocks on it. We don't predict the market. We read its memory. When promised yield becomes a prison sentence, the PGI Global Ponzi Confession. You can always tell when a story is built on certainty. It needs constant feeding. And when the feeding stops, the structure does not bend, it collapses. Here, we watch a man sell daily returns, then meet the quiet arithmetic that ends in 20 years behind bars. You and I both know this pattern, even if we have never named it. Someone offers you a world without waiting, Bitcoin exposure, foreign exchange mastery, profits that arrive daily as if time itself could be negotiated. And the first paradox appears immediately. If the returns were that reliable, why would they need you at all? In the United States, the chief executive of Praetorian Group International was sentenced to 20 years in prison for running what prosecutors described as a global Ponzi scheme, dressed in the language of Bitcoin and foreign exchange trading. Not a market strategy, but a story. Not investment, but choreography. The man at the center was Ramil Ventur Palafox, 61 years old. He promised daily returns as high as 3%. 3% per day is not just optimism. It is a declaration that uncertainty has been defeated. And that is where human action gives him away, because real markets do not sign contracts with your imagination. More than 90,000 people were drawn in, and authorities say over $62.7 million was drained. Between late 2019 and 2021, the operation collected more than $201 million from investors, including over 8,000 Bitcoin. The numbers are large, but the mechanism is simple. New money was used to pay old claims, while millions were diverted for personal use. Here is the micro hook you should sit with. If the product is profit, why is the real work always persuasion? To keep the illusion alive, Palafox built an online portal where investors could log in and watch their profits grow. But the growth was not market discovery. It was fabricated digits arranged to mimic legitimacy. A screen can be a window, or it can be a mirror. In this case, it reflected what people wanted to believe, and what was bought with the difference between belief and reality. Prosecutors describe luxury homes in Las Vegas and Los Angeles, penthouse suites at expensive hotels, and a taste for spectacle. $3 million on luxury cars. Another $3 million on designer clothing, watches, and jewelry. Not because these purchases were necessary, but because they are symbols that signal success to the next wave of contributors. Second micro hook. What convinces faster than visible wealth, even when the wealth is funded by the convinced? The investigation involved the Federal Bureau of Investigation and the Internal Revenue Service. Victims may be eligible for restitution. The Securities and Exchange Commission is pursuing civil penalties, and Palafox remains barred from handling securities. The state arrives late, as it often does, but it arrives to formalize what the market had already whispered. The cash flows never match the claims. So we end where we began, with the temptation of certainty. You are not foolish for wanting stability. You are human. But when someone offers you returns that ignore risk, they are not removing uncertainty. They are relocating it onto you, quietly, while you watch a portal and call it proof. If you feel a chill reading this, keep it. It is the mind remembering a rule it once knew. Time cannot be cheated, only reassigned. And the question that lingers is not how many years he received it, is how many people needed the promise before they noticed the price. And if you're here right now, don't just watch. Talk to us in the chat, share what you see, what you feel. The algorithm can't read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. When Bitcoin's uptrend breaks, Only one level restores belief. You can feel it in the way people talk when price stops climbing. Not panic, not calm either, just a quiet search for a line in the sand. We are going to trace that line and why one number has become the market's test of conviction. A long-term rally does not die with a headline. It dies when buyers stop proving themselves. And in the view shared by Jean-David Péquignot of Deribit, that proof does not return until Bitcoin climbs back above $85,000. You have watched Bitcoin settle into a narrow corridor lately, hovering between $60,000 and $70,000. That range looks peaceful, but it is not peace. It is hesitation made visible, especially when you remember it sits roughly 45% beneath the record high reached in October. Here is the first deduction we can make together. When a market falls below a level that once held it up, it is not merely losing value, it is losing agreement. Bitcoin slipped under $85,000 near the end of January, and since then the longer horizon has looked, in Péquignot's words, structurally broken. Why does $85,000 matter so much? Not because it is magical, because reclaiming it would signal something very human. Buyers have absorbed the supply that previously overwhelmed them. In plain terms, it would mean the sellers who ruined the trend have been answered, not with arguments, but with bids. Ask yourself this. If price cannot reclaim the level where belief failed, what exactly are traders betting on when they buy? Hope can lift a day. It cannot rebuild a chart. At the moment, Bitcoin trades far below that make-or-break threshold, recently near $66,600. That gap is not just distance. It is a reminder that the market is still in a posture where the easiest path can remain downward, simply because fewer people are willing to stand in front of falling momentum. Now we move to the next pressure point. If $85,000 is the ceiling of restored confidence, $60,000 is the floor of fragile patience. Péquignot points to $60,000 as the next major support, a psychological marker where large clusters of buy orders have historically waited like a crowd behind a door. Microhook. What happens when a psychological floor stops being psychological and becomes arithmetic? Because if $60,000 fails to hold on a closing basis, the market does not suddenly become irrational. It becomes more honest. Traders then look for the next place where history suggests forced selling exhausts itself, and that brings us to the 200-week simple moving average. This average has earned its reputation the way all market landmarks do, through repetition under stress. Since 2015, multiple bear market lows have approached this measure, turning it into a reference point for those who hunt bargains when fear is thick and liquidity is thin. Today, that level sits around $58,000. Microhook. Why do so many people who claim to ignore charts still gather around the same one when pain arrives? Because even the most fundamental participant still acts in time, and time creates memory. The 200-week measure is less aligned than a shared recollection of where capitulation has previously slowed, where the last impatient hands often surrender. So the map becomes clear. Above $85,000, buyers demonstrate control again. Around $60,000, the market tests whether confidence has any spine. And between $58,000 and $60,000, traders see what Péquignot calls the ultimate support zone, the place where this correction may be forced to confess what it really is. We are not watching numbers. We are watching coordination. And the question that lingers is simple. When Bitcoin reaches its next threshold, will you see a price level? Or will you see the moment human conviction either returns quietly or slips away without ceremony? Bitcoin drifts back toward last week's floor as artificial intelligence doubt hits tech and metals. When fear changes its target, you can watch correlations wake up again. Here, we trace how Bitcoin's retreat, software's stumble, and sudden drops in gold and silver all point to the same thing. Investors repricing certainty in a world that feels harder to forecast. You felt the lift above $70,000, didn't you? And then you watched it evaporate, not with a bang, but with that familiar quiet surrender where the market admits it never fully believed the rally. Bitcoin slid back toward last week's lows, giving up nearly all the progress it made of $70,000 and settling again around $65,000. Not because Bitcoin forgot how to rise, but because the crowd remembered what it was actually trading: confidence under uncertainty. Over the past 24 hours, Bitcoin fell about 2%, and the rest of the major coins moved like they were tethered to the same mood. Ethereum softened, Solana followed, and what looks like separate assets starts behaving like one shared bet when the room gets tense. Now we ask the uncomfortable question that always returns at moments like this. Are you watching a crypto move, or are you watching a tech move, wearing a crypto mask? The decline echoed what happened in the Nasdaq, which fell about 2%, but the sharper confession came from software. A major software-focused fund dropped roughly 3%, and it has fallen about 21% so far this year, as investors stare at expensive valuations and wonder what happens when artificial intelligence agents can write code faster than the humans those valuations were built around. Think about what that means in plain human terms. If the market starts believing that the skill once considered scarce is becoming abundant, then yesterday's premium begins to look like yesterday's story. A macro strategist put it simply: software stocks are struggling again, and the software fund is drifting back toward last week's panic lows. But then came the line that matters, the one that ties your screen together. Do not forget there is another kind of software, programmable money, crypto. Same category, same psychology. Here's the second hook, and it is almost too clean. If investors are repricing software because artificial intelligence changes what code is worth, what are they repricing when they sell programmable money alongside it? Not the chain, not the math. The narrative of future usefulness, discounted back into today. And just when the day seemed content to punish only risk assets, the old refuges flinched too. Gold and silver moved calmly for most of the session, then dropped sharply in the mid-afternoon, as if someone pulled liquidity out from under the floorboards. By late trading, silver was down about 10.3% to roughly 75.08 cents per ounce, and gold was lower about 3.1% to around $4,938. So we end up here together with a strange symmetry. Tech falls on artificial intelligence fear. Crypto falls because it has been trading like a high beta expression of the same belief. Even metals drop, reminding you that safe is sometimes just another crowded trade when everyone reaches for the exit at once. If you want a quiet exercise, hold this pattern in your mind the next time a headline tries to isolate one asset from the rest. The market rarely moves in isolated chapters. It moves in shared assumptions. And the real question is not what fell today. It is which belief stopped feeling solid all at once in the minds of strangers you will never meet. And if you're here right now, don't just watch. Talk to us in the chat. Share what you see, what you feel. The algorithm can read silence. It only reads movement. Every message, every reaction keeps this current alive. Subscribe, share, and let others join this signal. Together, we turn insight into motion. Tom Lee's quiet warning. Stop hunting the bottom, start seeing the dip. You and I keep learning the same lesson in different costumes. The market does not reward perfect timing. It rewards prepared conviction. In Hong Kong, Thomas Lee frames the current crypto pullback as a small winter, not a funeral, and he asks you to look for entries while others look for excuses. You feel the temptation, don't you? To wait for the exact floor, the perfect candle, the moment where risk disappears. But notice the contradiction. The moment risk disappears is the moment opportunity has already been purchased by someone else. So when Thomas Lee steps onto a stage in Hong Kong at Consensus Hong Kong 2026, he is not really talking about charts. He is talking about human action under uncertainty. He tells you to stop obsessing over the precise low and start looking for places to enter. Not because he knows the future, but because he understands your instinct to freeze when prices move against you. You should be thinking about opportunities here instead of selling, he says. And beneath that sentence is a simple claim. Panic is not analysis. Bitcoin, in his telling, is not collapsing, it is confessing. A drawdown of roughly 50% from the highs reached in October is painful, yes, and it is also familiar. The crowd experiences it as chaos. The market experiences it as repricing. Here is the first micro hook. If everyone is watching Bitcoin, what are they missing that is moving the whole room? Lee points your attention away from crypto for a moment and toward metals. He argues that volatility in gold and related markets rippled outward, pressing on everything labeled risk. When gold's market capitalization can swing by trillions of dollars in a single day, the story is not just about wealth changing. It is about leverage getting exposed. Margin calls do not ask what you believe. They ask what you can pay. And when forced selling begins, it does not discriminate. It sells what is liquid. It sells what can be sold now. That is how a shock in one corner becomes weakness everywhere else. Not because the assets are identical, but because the humans holding them are connected by the same constraints. Second micro hook. What looks like a crypto winter might actually be a liquidity winter wearing a crypto mask. Lee makes a relative bet, not an absolute prophecy. After Bitcoin lagged gold through 2025, he suggests gold may have already done much of its work for this year, leaving room for Bitcoin to outperform into 2026. This is not mystical. It is rotation logic. When one trade becomes crowded, the next opportunity often emerges where disappointment has already done its damage. He applies a similar lens to Ethereum. Since 2018, repeated drawdowns of around 50% have often been followed by sharp rebounds. You can hear the pattern and still respect the danger. A pattern is not a guarantee. It is a map of how crowds have behaved under similar stress. Citing technician Tom DeMark, Lee adds a more specific idea. Ethereum might briefly slip below $1,800 to form what DeMark calls a perfected bottom before a steadier recovery. Whether that exact level matters is secondary. The deeper point is psychological. Markets often demand one more moment of discomfort to flush out the last holders who needed certainty before they could hold. But we should not pretend forecasts are clean just because they sound confident. Lee's recent record is mixed. In August 2025, he projected Bitcoin could reach $200,000 by the end of that year. Instead, Bitcoin peaked around $126,000 in October, then fell to about $88,500 by December 31st. Later, he suggested a new all-time high could arrive in January 2026. By January 31st, Bitcoin had slid to roughly $78,500. So what do we do with that? We do not worship the forecast, and we do not dismiss the reasoning. We separate the impulse to predict from the discipline to position. Timing the bottom is a desire to eliminate regret. Buying the dip carefully is a willingness to accept uncertainty in exchange for asymmetry. And if you sit with that for a moment, you can feel the real message hiding behind the market talk. The crowd wants permission to act. The market never gives permission. It only offers prices. If this idea stays with you later, it will not be because of a number or a stage in Hong Kong. It will be because you recognized yourself in it, the part of you that waits for certainty, even though certainty is the most expensive asset of all. We are blocksonic. We do not predict the market. We read its memory. And the question we leave you with is simple. When the next dip arrives, will you be searching for the bottom? Or will you be noticing what your hesitation is really trying to protect? When a YouTube audience becomes a bank, the mere beast bet on a new financial order. You and we have been trained to look for the next great financial gatekeeper in familiar places. But this story asks a quieter question. What if the next on-ramp to investing in crypto is not built on Wall Street's legacy, but on attention, trust, and habit formed long before anyone opens a brokerage account? You can feel the tension, can't you? We keep calling finance a world of institutions. Yet the next institution might be a relationship. In Hong Kong, Thomas Lee, the chairman of the Ether Treasury company Bitmine Immersion, offered a simple deduction. The next generation's defining financial platform may arise from YouTube, not from a marble lobby. Not because entertainment magically becomes banking, but because distribution is destiny when trust is scarce. He points to Mr. Beast stepping into banking through an agreement to acquire the neobank step. Bitmine invested $200 million into Mr. Beast's company, and Lee frames it as a long game about one thing: how young people will choose to access money, saving, investing, and eventually crypto when they finally have something to protect. Here is the first reveal. Finance does not begin with wealth. It begins with interface. The place you first learn to move value becomes the place you later learn to store it. Lee's claim is not that Mr. Beast is a banker in the traditional sense. It is that he could become the default financial home for Generation Z and Generation Alpha, the first screen they trust when the stakes start to matter. And once a platform becomes default, every additional service feels less like a decision and more like gravity. Ask yourself this micro hook. What is a bank, if not a habit with a license? To make the pattern visible, Lee compares eras. Charles Schwab aligned with baby boomers. BlackRock and Blackstone became magnets for Generation X capital. Robinhood captured millennials by making participation feel native to the phone. Each time, the winner was not merely the best product. It was the institution that matched the generation's time preference, their patience, and their sense of what feels normal. Now, look at the numbers Lee uses to anchor the logic. Generation Z, Generation Alpha amount to about 120 million people in the United States alone. Mr. Beast has built an audience of more than 1 billion followers globally. This is not a balance sheet argument. It is a coordination argument. When attention concentrates, distribution becomes cheaper than persuasion. Second microhook. If trust is the rarest asset, who already holds it before the first paycheck arrives? Lee admits the obvious constraint. These customers are not necessarily wealthy today, but that is precisely why the move matters. Over the next decade, they will participate in a major wealth transfer, and the first platform they use will shape what they consider safe, what they consider normal, and what they consider possible. And that is where crypto quietly enters the frame. If STEP becomes their primary financial platform, Lee argues, then Bitmine's position and its investment in Mr. Beast's company could sit at the center of a generation that experiences digital assets not as a speculative detour, but as a native extension of financial life. We do not need to romanticize this. We only need to observe human action. People do not adopt tools because they are objectively superior. They adopt what reduces friction, what feels socially legible, what fits the rhythm of their day. The on-ramp is rarely a lecture. It is a doorway you walk through without noticing you crossed a border. So we end with a quiet thought. If a creator can become a bank, it is not because finance has become entertainment. It is because finance has always been belief made operational, and belief follows the paths where you already live. Sit with that for a moment, and you may find yourself wondering which institutions are real and which ones were only familiar. Metaplanet keeps buying Bitcoin while its own price falls. You can feel the tension here, can't you? A company chooses to lean harder into its conviction at the exact moment the crowd punishes it for believing. Metaplanet is doing that now, accumulating Bitcoin while its shares sink and its average cost sits far above the market. You and I both know what this moment really tests. Not the math, not the headlines, but the human ability to hold a plan when feedback turns hostile. Simon Gerovich, the chief executive officer of Metaplanet, looked at falling confidence and answered with the same message. We keep accumulating, we keep building revenue, and we prepare for the next phase. He thanked shareholders who stayed. And notice what that gratitude implies. When Bitcoin trends downward, support is no longer passive. It becomes an active choice because the price is now broadcasting doubt in real time. Bitcoin itself has been unkind to late certainty. It fell more than 47% from its record high in October, and it dropped another 14% in a single Thursday. That is not just volatility. That is the market asking, who was buying a thesis and who was buying a feeling? Now look at Metaplanet's own stock, because it is the second mirror in the room. The shares ended the week around 340 yen, after falling roughly 82% from a June high near 1930 yen. Even on Friday, the stock slid again, down 5.6%, trailing Bitcoin's slump from the prior session. Here's a micro hook worth sitting with. When a company becomes a proxy for an asset, are you investing in management or renting exposure through a symbol? Metaplanet's plan is not small, and that is the point. The 555 million plan targets 100,000 Bitcoin by the end of 2026 and 210,000 Bitcoin by 2027. Its holdings have already jumped from 1762 Bitcoin at the end of 2024 to 35,102 Bitcoin now, valued around $2.5 billion at current prices. But conviction has a cost, and the market makes sure you feel it. Metaplanet's average acquisition cost is about $107,000 per Bitcoin, while the current price is about $66,270. Deep in the red is not an insult here. It is a description of time, preference colliding with timing. And then there is the quiet weight most people skip over: debt. The company carries roughly $280 million outstanding. Debt changes the texture of risk. It does not care about your philosophy. It cares about schedules. Another micro hook. What happens when a long-term asset meets short-term liabilities? The answer is never ideological. It is always practical. Zoom out and you see Metaplanet as part of a global hierarchy of corporate Bitcoin holders. It ranks fourth among publicly traded companies, behind Strategy Incorporated, Mara Holdings, and 21 Capital. And that ranking itself tells you something human. Once a strategy becomes legible, it becomes competitive. Firms start measuring each other not only by earnings, but by how much monetary hardness they can warehouse. To keep buying and to reduce pressure, Metaplanet announced on January 29th that it intends to raise up to 21 billion yen. The funding method is dilution and optionality. The sale of 24.53 million new common shares at 499 yen each, paired with stock warrants aimed at select investors. In plain language, they are trading slices of future ownership for the ability to survive the present and accumulate more of the asset they believe will matter later. And this is the real structure underneath the story. When prices fall, they do not merely destroy wealth. They reveal which promises were conditional. So we sit with the question that lingers after the numbers fade. If a company keeps buying while its own market value collapses, is it demonstrating discipline or desperation? And if you can't tell yet, that uncertainty is the message the market is sending you to interpret. We are block-sonic. We are block-sonic. We don't predict the market. We read its memory. Weak earnings expose the cost of ambition as Bitcoin-linked stocks find their footing. You can feel the split, can't you? One side is punished for promising the future too early, the other is rewarded for surviving the present. Today we watch earnings miss, spending plans swell, and a Bitcoin rebound quietly reprice the mood. We start with iron, and the first lesson is simple. Transitions are expensive, especially when you try to change your identity in public. The company is accelerating its move from Bitcoin mining toward artificial intelligence cloud, but the numbers arrived before the story was ready. Revenue and earnings per share both fell short of what the market had already imagined. Look closer and you see the shape of the disappointment. Second quarter revenue slid to $184.7 million, down from $240.3 million in the first quarter. And the loss was not a rounding error. A net loss of $155.4 million is the kind of figure that forces everyone to ask what is real now, not what might be real later. Here is the paradox. The same market that demands vision also demands proof. Iron points to scale and certainty through financing and prepayment, securing $3.6 billion of graphics processing unit financing tied to its Microsoft contract, alongside $1.9 billion customer prepayment. Together, management expects this to cover about 95% of graphics processing unit related capital expenditure. But you and I know what the price system is saying. Funding is not the same thing as profitability. Coverage is not the same thing as competence. And now the first micro hook. When a company says it has the capital, do we ask where the capital came from, or what it must now deliver to deserve it? Amazon steps in next, and the crowd does what crowds always do. It stops listening to the past and starts staring at the future. Earnings per share missed expectations, revenue beat them, and the attention immediately migrated to the plan. Roughly $200 billion of capital expenditure in 2026, largely aimed at artificial intelligence. The shares fall about 10%, not because spending is evil, but because spending is a confession. It tells you the firm believes the next battlefield will be expensive, and it intends to pay the entry fee. Second micro hook. What if the market is not punishing investment at all, but discounting the uncertainty that comes with building something no one can fully price yet? Then Bitcoin moves, and the tone changes without anyone announcing it. From around $60,000 to $66,000, the rebound acts like a small clearing in fog. Crypto-exposed equities respond the way coordinated expectations respond when the reference point steadies. Strategy rises about 7% in pre-market trading. Galaxy gains about 7%, Mara Holdings follows, and Coinbase lifts about 6%. Notice what ties this together. Earnings misses are not just failures of management. They are collisions between dispersed expectations and scarce reality. Capital expenditure plans are not just ambition. They are bets placed under uncertainty. And Bitcoin's bounce is not just a chart event. It is a shift in the shared story of risk, liquidity, and patience. So we end in a quiet place. You can watch these moves as separate headlines, or you can see the single structure beneath them. Markets are not machines that output prices. They are conversations that punish pretense and reward coherence. And if you find yourself wanting to argue with the tape, it might be worth asking what part of the story you were relying on that the price no longer needs. We are Blocksonic. We do not predict the market. We read its memory. United States job losses hit a 17-year peak in Bitcoin. Here's the signal beneath the noise. You can feel it when the labor market turns, long before the official story admits it. We are watching early fractures form in hiring, and those fractures quietly pressure the central bank toward easier money. And when policy loosens, the assets built for uncertainty often wake up first. Here's the paradox you came for. Bad news for workers can become good news for Bitcoin holders, not because suffering is bullish, but because institutions respond to suffering with cheaper credit. We are seeing the United States jobs market cool quickly, and the timing matters. When employers lose confidence, they stop expanding. When they stop expanding, the economy slows. And when the economy slows, the Federal Reserve faces a choice that is never purely technical: protect purchasing power or protect employment. Planned layoffs the cuts companies announced before they execute surged in January to 108,435. That is not just a large number. It is a memory. The last time we saw a January reading this high was January of 2009, when the world was still absorbing the collapse of Lehman Brothers and the recession it pulled into view. Waddle. Look closer, and the year-over-year change tells you what the headline tries to hide. Announced cuts rose 118% from a year earlier. This is happening in the first year of Donald Trump's second term, and whatever your politics, the market does not vote, it reallocates. Employers are reallocating toward caution. Technology, the industry that once hired as if time were free, announced 22,291 reductions. Amazon carried much of that weight. United Parcel Service announced 31,243 planned cuts. Different sectors, same message. The future looks less certain than it did when those payrolls were built. Andy Challenger called it a high January figure, even for a month that is usually weak for hiring. And then he said the quiet part out loud. Many of these plans were set at the end of 2025, which means the decision was made before the calendar turned. In other words, this is not a sudden panic. It is a slow decision to stop pretending. Now notice the tension. The Bureau of Labor Statistics payrolls report still paints resilience. Official data says steady. Private signals say strain. Both can be true for a while, because large systems do not update all at once. By the time the official numbers confess, the incentives have already moved. Ask yourself this: which data series moves first, the one built to be precise, or the one built to be immediate? That is why these unofficial indicators matter. They are not perfect, but they are early. Earlier this month, a blockchain-based measure from Truflation suggested real-time inflation dropped sharply to under 1%, even while the official consumer price index remains well above the Federal Reserve's 2% target. When inflation cools faster than the institution expects, the institution's justification for tight policy weakens. And here comes the second hook, the one most people miss. What if the real story is not layoffs, but the shrinking political space to keep money expensive? Put the pieces together and you can see the path forming. If employment weakens and inflation softens, the Federal Reserve is pushed toward lowering borrowing costs to support activity. That shift tends to lift assets that benefit from liquidity and risk appetite. Bitcoin lives in that category, even when it pretends it does not. Bitcoin is still down nearly 50% from its record high of over $126,000. That drawdown is not just volatility. It is the market asking, how scarcity when credit is tight? If credit loosens, the question changes. This month, the Federal Reserve left its benchmark rate unchanged, sitting in a range of 3.5% to 3.75%, while emphasizing inflation concerns. Analysts are split because they are trying to forecast a committee that is trying to forecast you. One major bank expects rates to stay where they are through this year, then rise sometime in 2027. Others expect at least 2 cuts of 25 basis points this year. And then there is the political calendar hovering over everything without needing to announce itself. One economist who previously called Japan's fiscal strain expects Kevin Warsh, Donald Trump's nominee for chair, to cut rates by 100 basis points before the midterm elections in November. Whether that is right is not the point. The point is that expectations are forming, and expectations move capital before policy moves rates. So we end up here, you and I, staring at a simple mechanism dressed in complex language. Labor weakens, pressure builds, money gets cheaper, and the market reprices what it thinks the future will feel like. If you want to understand Bitcoin, watch the human need beneath the chart. The need for relief, the need for stability, the need to make tomorrow less expensive than it looks today. Sit with that for a moment and tell us what you think the market is really pricing right now, fear of inflation or fear of slowing. We are Blocksonic. We do not predict the market. We read its memory. Thank you for staying with us. Through the noise, the charts, the truth. You are part of this signal now. We'll be back soon with more stories, more logic, more discovery. Until then, keep your eyes on Bitcoin and your ears tuned to the sound of freedom that never stops playing. This is Blocksonic. You don't have to